And welcome. It's Mary Ellen McGonagle here with your Friday afternoon MEM Edge Show, the show where we bring you where the action is in the broader markets. And another bumpy ride, certainly with a very negative close on today's market. We did have quite a bit of news leading into today. Most impactful were news items that came out today. So on Wednesday, we did get notes from the FOMC's latest meeting. And in light of the government shutdown and a lack of economic data, this did become a centerpiece. And in those notes, it was noted that the Federal Reserve is mixed, generally on board for a rate cut, but there's a cautious tone to that. So that gave the markets some pause going into news later in the week. Certainly overall, as noted, the Senate is failing to reopen the government. And in turn, as time continues to drag on, initially it was viewed as something that would pass quickly. We are at an impasse, and that is certainly causing uncertainty within the markets as well. Also noted today was that federal layoffs have begun, and this is something that was mentioned would take place if the government remained closed. So more by way of uncertainty entering into the markets. And also today, most impactful, Trump's talk of China and renewing tariffs, also potentially not holding the meeting that was due to take place between China and the US later this month. And that certainly was the primary driver relative to the markets pulling back very sharply today. So we are going to get into that, talk about some of the sector rotation in response to that. In addition to the trade war escalation, China did come out and say that they are going to reduce access to rare minerals, and China is the largest producer of these minerals. So those two factors certainly were at play regarding today's sharp pullback. So from here, let's go ahead and take a look at the S&P 500 as well as the Nasdaq. You will want to be tuned in to what today's price action did to the charts and then also beyond. And here we are, daily price chart of the S&P 500. And you can see we were down over 2.5% on the day. Very high volume on that selling. In turn, the RSI is now in negative territory, and we have that S&P 500 only 0.6% above that 50-day simple moving average. Now, I do highlight that because this is a metric that is widely followed. Oftentimes, a move below or above this key moving average will command its own response. We did have a pullback in December, all about uncertainty going into the inauguration of a new president, and there was a lot of volatility following that and a recovery. But let's take a look at this break below the 50-day simple moving average, and we can see that we also had a negative MACD and a negative RSI and a big pickup in volume, which preceded this bear market. Now, before anyone says the word bear market at this point in time, I did want to highlight the fact that in the history of the broader markets and these indexes, there has never been a 20% or more failing or drop in the markets twice in a 12-month period. So with that in mind, it doesn't mean as a fact that it will not take place, but of course, looking at charts is all about using historical precedent. So let's go ahead and take a look at a daily chart of the Nasdaq. It did get hit harder today. It was down 3.5%, also moving closer to that 50-day simple moving average. And we now have a negative RSI with the index below its 21-day simple moving average. So certainly a shift here. Again, you will want to go back and take a look at historical precedent relative to that RSI turning negative and what the impact can be. From here, I'm going to take us to a weekly chart for the Nasdaq. This is going to impact your longer term outlook. And highlighting here the fact that going into this week, this is something I talked about in my MEM Edge report last Sunday, is the fact that the RSI was in an overbought position. From there, I did highlight the prior recent periods, the RSI on the weekly of a major index being in an overbought position is not a common occurrence. So if we go back to these other 3 periods on the weekly, this is taking us back to 2023, we can then take a look at the price action following this overbought condition. There certainly are going to be times where it's overbought and you get minor pullbacks. Today, we're going to be focusing on the more severe pullbacks, only to provide precedent as far as what to potentially be on the lookout for. So on the weekly, if we go back to this July into August period here, when we had that RSI in an overbought position, we did pull back pretty significantly as far as the news items that drove this pullback. There was at that time a very similar threat of a government shutdown in the September period. There also was conflict in the Middle East, and interestingly, the conflict was somewhat resolved there this week, but we also had higher interest rates, and the Fed was in the mode of keeping those interest rates higher. So again, interest rates, government shutdown, and conflicts geopolitically were part of this pullback, somewhat similar to what we are seeing now. But let's take a look at what took shape in the Nasdaq during this pullback period. We did have that MACD trending lower, but it did remain up here in positive territory. We also did have that RSI on the weekly enter below that 50. And again, this is not a common occurrence. However, the good news is that we were able to stay above that 200-day and rebound quite nicely. But certainly those of you that are in the markets and in Nasdaq related names, you will want to take a look at that weekly to guide your selling that you may want to do to preserve your profits. So moving through and taking a look here at the Nasdaq at other periods where we had a pullback, this is taking us to the May into June period of 2024. At that time, high inflation and the economy being very strong also kept that interest rate backdrop high. And in turn, we did see a rather short-lived one-day pullback. The good news here is that the RSI stayed in positive territory. So using that weekly chart, you could have stayed with your holdings in the high growth Nasdaq area. And then from here moving forward, you can see that we had that pullback in 2024. Again, the RSI remaining above this net neutral. So we had a rather short-lived pullback. This is going to take us into this year. And you can see this is that bear market period. We did have an RSI prolonged decline below that 50, which is your net neutral. And then eventually we did get that MACD into negative territory, which preceded further deterioration. So at this point in time, we are just entering below that 70, taking that RSI out of an overbought position. And that is ideally what you want to see as a way to potentially set up for further upside. Now, I will tell you, we are going into earnings season, so that's going to create its own bumpiness, if I may. So let's go ahead and take a look at some other charts that are going to be really super powerful as far as providing you further insight to what is taking shape here in the broader markets. In this view, we are looking at the S&P 500, and what I wanted to highlight here in this daily chart again is the overbought position coming out of that, what that can in fact look like? Actually, I'm going to show us a different view of the S&P 500, and this is that weekly chart. And what does take shape when the RSI, we just dipped into positive territory last week, and what the general pullback or average pullback of that removal of the RSI on the weekly chart can amount to. But at this point in time, this is your 10-week moving average. We are still finding support. From here, I'm going to take us to another view, and this is a chart of the stocks in the S&P 500 that are above their 20-day simple moving average. So in essence, your growthier leading names would certainly be a big part of that list. And you can see we had a very dramatic drop, 36% of stocks that were above their 20-day simple moving average did pull back and are now below that key metric. And of note as well is the fact that we were diminishing or receding as far as the number of those leadership names going into today. And also, I do have it marked up here at that 28% level, primarily to take us back to these longer pullback periods. So you can see if we do get below that 28, which is where we are at this point, a drop below that can lead to further downside among those leadership names that are above their 20-day simple moving average. Let's take a look at the equal weighted S&P 500. And what I wanted to highlight for you here is these are the names that are all having an equal weight. The M7 names are not overweighted as they are in the broader S&P 500 index. And I wanted to highlight this close below the 50-day simple moving average with a negative RSI. And again, a close below that 50-day is not standard, but it is indicative of the fact that most areas did pull back in today's market environment. But we are going to drill down as always and get a better feel for what truly took place beneath the surface of the broader markets. So this is a daily price chart view. It is 2 months of price action, and it's the 11 underlying sectors in the S&P 500. And of course, we can see that outsized pullback there in the S&P today. But let's take a look at these underlying sectors because a couple of them have turned negative, and you will want to be aware of that. First up is XLY. This is the consumer discretionary. We do now have a negative RSI, a close below that 50-day on heavy volume, and a negative MACD. This is an area that's going to be very closely tied to the possibility of a slowdown in the economy and other factors. And you can see that overall, the group is now in a downtrend. Another area that had been holding up remarkably well before this past entire week is XLC. That's your communication services area. The heavier weighted names in there are going to be Alphabet. Netflix actually was up for the week, and that is a heavier weighting in there, but also Meta platforms. But certainly of note is that we now have a negative bias going into earnings. So also technology, you can see that we had a sharp pullback down 4% today, super heavy volume. Also, XLI down quite a bit for the week overall, another very economically sensitive area of the markets. You can see that we have closed below that 50-day simple moving average, negative RSI, and very high volume moving through other areas of note that have moved into negative territory. Energy had been sitting up here nicely. This is another area that's going to be very economically sensitive. The price of oil was down about 3% today, and you can see that we now have a close below that 50-day on volume with XLE. And moving through, I also wanted to share with you the fact that financials are now back below that 50-day simple moving average. You can see that RSI now below 50, as well as the MACD. And then also there were areas that fared better, and it's all about relativity. Here we are with XLP. This is the consumer staples, and this area has been greatly underperforming, certainly those high growth areas. And you can see that we were not up quite a lot today. We were flat, but I am going to share with you a couple of names that you can keep in mind in the consumer staples, higher yielding area if you are looking to potentially diversify. You can see that the RSI is trending upward, but we are not in positive territory yet. We are seeing that MACD black line up through the red. So it certainly could be the beginnings of a move, and certainly worth noting. Here we are with XLV, and this is that big move into healthcare last week. Pfizer and Trump putting that deal together, which helped smooth or unruffle a lot of feathers relative to drug pricing. However, we did pull back into today's close. We still have positive metrics here with that RSI and MACD. And in addition to this move higher, based on that deal, healthcare, of course, is also defensive. Let's go ahead and take a look beneath those sectors. And we are looking at ETFs that can be very powerful as far as leading you toward areas that were able to somewhat sidestep today's pullback and those that may have faltered more. So first up here is gold, all about that flight to safety and other factors as well. And you can see that gold is sitting up here really quite nicely. From here, we can take a quick look at a weekly chart simply to highlight that we are up here at that 81 level, which is historically an overbought condition, but we did get nice high volume for the week into those safer haven gold stocks. Also sitting up here, a riskier area, but it is faring well, and that is biotech stocks, IBB. I did talk about this last week in my MEM Edge report relative to why there is strength in this area and what to anticipate moving forward, but it certainly is of note. Now, another area, TAN, is that Invesco Solar, and it did pull back 5.5% today, but you do still have generally positive notes on those indicators. Semiconductors, very economically sensitive, but also a lot of high-flying names in this particular area, and you can see it was down 6.3%, super high volume, but we did find support at this 21-day simple moving average. We have that RSI up here in positive territory. You will want to keep an eye on this MACD. If we get that black line down through the red, there are periods where that indicator may simply point to sideways price action, but it is quite simply indicating that this sharp uptrend has in some cases stalled, or we could see further downside price action. This is going to be a stock by stock type of sector, because there are some sectors that are some names in semis that are holding up really well. But I will share with you a name that got hit hard today on news. This is Qualcomm. The stock was down almost 7.5%, and all about China potentially looking into the validity of a deal that Qualcomm has done at least a couple of years ago, but certainly enough by way of news to pull that stock below key support. Another area that did get hit today and for the week, this is small cap stocks. Russell 2000 down 3% today. And as you may recall, for those of you that saw last week's show, you will know that I provided 3 stocks. We were on the lookout to see which one would outperform. So that is something that we are going to look at here very shortly. And then also we did see interest rates, or actually yields, coming down. This is all about the safe haven bonds, a move into bonds and treasuries, and you can see that the yield on that 10-year treasury is sitting there at about 4% now. So that is generally viewed as constructive. And then moving through retail, I talked about consumer staples, and here you can see a continued deterioration in these retail stocks. We now have a negative MACD, And we need only go back to this period to see similar price action. Again, all about fears of weak employment data pointing to less by way of consumer spending. Here's a look at KRE, that regional banking ETF, down 4% today. So quite negative for the group overall, another highly economically sensitive area of the markets. Any kind of tariff fears is going to impact retail as well as bank stocks and other areas. Also, let's take a look at home builders. This is an area that I know that I certainly did initially get involved in, but home builders, but I did sell as we continued to rally because the names were going up, but the fundamental backdrop for individual companies as well as the overall housing markets was not constructive. And you can see that we are continuing to decline despite a declining interest rate environment. And this is all about the realization that the overall industry, those fundamentals are just not there to support further advance in this area. Let's go ahead and take a look at those small cap names from last week. As you may recall, we had 2 software names and 1 semiconductor stock. And again, that's going to be an area, technology, that did in fact get hit certainly this week. First up here is Progress Software. The stock was down 2.5%. And I will tell you, going into today, this was the one name that was at the forefront, and it actually was positive going into today. Unfortunately, we did see a 3.8% pullback in PRGS, which in turn pulled the stock lower. From here, let's go ahead and take a look at another view. And what I'm sharing with you, and this is going to be helpful if you are looking at a stock, and in particular, for my work, small cap stocks that exhibit quite a bit more by way of volatility. And you can see quite simply the end of September, a sharp advance, and then a deterioration the following day. So just a lot of back and fill. One of the many reasons that I stick with larger names that aren't quite as volatile. But using this 60-minute chart, what I wanted to highlight for those of you that may have participated by actually purchasing some of the stock, I'm going to point out some characteristics to keep in mind as it relates to a stock's momentum potentially deteriorating. I've highlighted this new or near-term high on the 1-hour price chart, and you can see that as the stock is getting close to that prior high, we're not really seeing confirmation. This is a non-confirming RSI, which is trending downward despite the stock re-entering prior highs. However, you can see that you can stay with the stock on that 1-hour chart because the RSI is up here above positive territory. It did enter below that 50 going into yesterday's price action, and then we also closed below these shorter term moving averages with the MACD in a downtrend. And then certainly today that MACD entered into negative territory. So we had a bullish bias before the end of the week when we started to see negative technical price action on these indicators as a guide. Let's go ahead and take a look at the other software name. This is NetScout, NTCT, and it was another name that did get hit today, down 3%, as much because it is small cap as otherwise. However, we are still above that 50 for the RSI, which is good news, and the MACD. So if you are of a mind that the markets will certainly correct and come back, you can stay with NetScout as those momentum indicators are still in positive territory. Let's take a look at VECO, and this was an underperformer. It was down 11%. Now, a good 6% of that was today, but you can see that we did close the week now with a negative RSI, and then we have that negative MACD crossover in conjunction telling us that further downside could easily be ahead. Let's go ahead and drill down with this chart and take a look at the 1 hour price chart as your guide. Again, when looking at these smaller names that are going to trade a lot more actively or are going to be more volatile. So looking at VECO, you can see that coming into the beginning of this week, we did see the stocks price close below that net neutral with the RSI. We did close below the 5 and 8 hour simple moving average. And then we had that negative MACD crossover, and paying attention to that could have gotten you out of the stock at this point in time. And you can see that we never did, except for a momentary period here, move back above 50 with that RSI, and then a continually declining MACD. And by way of pointing out what to be on the lookout for with these 1 hour charts for the buy side, let's take a look at VECO in the beginning of September, and we have quite the opposite dynamic. The stock moves back above that 5 and 13 simple moving average. We have that RSI entering into positive territory, and we have a positive MACD crossover, which is confirmed by a move into positive territory. So again, using drilling down with some of these charts can be really quite helpful for these more volatile stocks. As mentioned, we did see some vibrancy in consumer staple stocks, which had been outperforming, and I wanted to share with you a couple of names. First up is Pepsi, and this downtrend reversal, I'm highlighting it because it took place on strong earnings, and this is that concept where the price is not sitting at a new high. They came out with good numbers. We're back above that 50-day simple moving average. Nice high volume characteristics. We now have a bullish MACD and a bullish RSI. Another name that we can look at in this space is CELH, and this is in the same area as Pepsi. And you can see Celsius Holdings has a nice base breakout sitting up here. We are now just a little bit below that, but this pullback could in fact be a buying opportunity for those looking to diversify. And then last up, Philip Morris. We are not quite back in an uptrend yet, but we are seeing some vibrancy. What I wanted to share with you as far as what to be on the lookout for is not just a move back above that 50-day, because we did get that head fake back here in mid-August, but you will want to see more of a sustained move back above that 50-day simple moving average, and then ideally look for that MACD to get in positive territory as well. You want to have that confidence that that new uptrend, and then of course, if it is married with some sort of announcement fundamentally that is good news, that of course would provide a lot more by way of a bullish backdrop. And that's it for this week. Again, quite a bumpy ride last week. For those of you that want to stay on top of these markets and have a solid plan, go ahead and use that button below for a free 2-week trial of my MEM Edge report. Also of note, I will be appearing at the Money Show in Orlando next Saturday, not this Saturday. So for those of you that are in the area or are attending, please be sure and stop by. Would love to say hello. And last up, if you like what you've seen, be sure and hit that like button. As always, I hope you have a fantastic weekend. I'm going to look for you here again next Friday.